So we'll go ahead and kick things off. I first want to say a huge thank you to everyone for attending today. Big thank you to Scott Belt and Eric Johnisee. So we have Scott Belt here today with Impact CFO Services and Eric Johnisee of Drive Accounting. And in all the craziness of the world, they agreed to do some presenting for us today on budget planning and forecasting. And we're going to keep this upbeat because everybody on this call is really excited about budget planning and forecasting. We're going to do a lot of learning today, and of course we're recording this, so we would encourage you all to share it with your peers, let people know that it will be available on the Tigard Chamber website in the future for future viewing. And with that, what I'd love to do is kick it over. We'll start with Scott, and then we can go to Eric. If you don't mind just introducing yourself briefly and tell us who you are, and you give us a quick qualifier. Why should we hear from you about this particular topic?
Well, Scott Belt, Impact CFO Services. We at Impact help you let your numbers tell a story of what your business is doing, how your business is doing, and where it's going. And the planning is, I think it's the fun part of being a business owner, because you really get to put into numbers and action what your 10-year business plan is. And so that's kind of the fun part. So, anyway, Scott Belt, Impact CFO Services. I don't know if you want any more than that on the introduction. Eric?
Hi, Eric Johnisee, Drive Accounting. I know at least half of you. So where Scott helps people use a lot of that information to drive their businesses forward and to help analyze it and make plans and whatnot. Our company, we focus primarily on bookkeeping and QuickBooks. So we're helping people gather and track that data, so this way you have good information to be able to make important decisions or informed decisions about your business. So why this stuff really turns me on is imagine coaching a football game, but you couldn't see the score or stats until the end of the game. How good of a coach are you going to be? And that's what this information really does. It lets you plan, it gets your destination, you know where you're headed. And they have that old adage, if you fail to plan, you plan to fail. And so many business owners leave this part out, and it doesn't have to be difficult. But if you don't have a plan, and I've done it myself, where I just thought that working hard is enough, and I tell you, having a plan 10 times out of 10, you end up further along. And so we try to do this with all of our clients. Not all of them are receptive to it, but the ones that are the ones that we're seeing are growing, are having less problems, and they're able to pivot during times like this, when what we're dealing with in 2020. So that's why I'm passionate about what we do.
Fantastic. Thank you both so much. So why don't we kick it off? I know the first question I was hoping you guys could tackle for us is, what is the difference between budget planning and financial forecasting?
Okay, well, I'll grab that one off the top. If you think about budgeting itself, budgeting is a tangible thing that you're putting together that you're going to actually measure yourself against, whether that's a budget to actual on the revenue side or on the expense side. It gives you an idea of what you can spend on a particular item. Catherine was just talking about earlier. She's like, I get a budget. It's so freeing because I know exactly what I can spend. I know exactly what I can do. When you don't have that budget, you're like, well, can I? And especially when you're the business owner, you start cutting when you probably don't need to, because you're like, well, I don't know if I can afford it. And if I don't know, I'm not going to spend it. When that might be something great for your business. Marketing and advertising is a great example of that. People a lot of times like, I don't know if I can afford it. Well, if you budget it in, just spend what you budget, because you've already factored in what your revenue and your expenses are going to be, and you can afford it per your budget. And then you're going to track yourself each month, each week, each quarter on how you're doing against your budget. As far as financial forecasting is concerned, this is kind of more of a long-term look on your company, and also you start adjusting it a lot more quickly based off of different factors that happen. Like, for instance, we'll take this year into consideration. COVID kind of hit in March. It really started hitting in March, and then businesses were shut down in March. Well, you're going to get down and you're going to start reforecasting really quick. Does that mean you're going to change your budget? Well, not necessarily. You probably need to change your budget in the second or third quarter, but you're not going to go instantly to your budget. You're going to go to your forecasting. Okay, what did my revenue numbers just do? What are my options? How am I going to grow out of this? And you're going to start adjusting things very quickly based off of your forecast. Versus a budget, it's kind of set in stone for that year, and then you're going to re-budget accordingly on major changes that happen. Forecast can be subtle changes. Sales is a great example of a sales forecast. You're going to be reforecasting your sales probably weekly, might even be daily based on your meetings. You're going to be reforecasting. Well, you can't change your financial budget based off of a meeting, but you can change your sales forecast based off of a meeting. Also, your budget tends to be more quarterly or annually versus a forecast can be weekly or 5 years. I mean, there's really no time constraints on that, but you're going to be changing it kind of quickly. On your short term, on your long term, you're going to be changing it as it needs to be. On your budget, you're going to be budgeting for quarterly or annually, and then you're going to be measuring yourself against it. Eric, do you have anything you want to add on?
No, I agree with everything that you said there. For me, when you forecast, that's really when you're sitting down and doing that dreaming, that planning, and saying, hey, okay, I think this is what we can do. Like Scott said, especially when COVID hit, you're having to figure out, okay, hey, what did this just do to my sales, and what's that going to do to the rest of my numbers, so that you can really make plans. Where budgeting comes in is really where you're paying attention to how your money is leaving you, and running a lot of budget versus actual reports, so you can see, hey, how am I spending against what I planned to spend? Now, we know that budget, when COVID hits, you very well may go out the window, but you're not adjusting that budget without doing that forecasting first. That forecasting is the big thinking, the big thinking, either the long-term planning or even, like I said, that short-term planning. So that's right. I agree completely.
Fantastic. My recap of that in my layman's terms, let me know what you guys think of this. I feel like the budget is what you can spend, right? Your forecast is what feeds your budget. Is that too simple?
We'll go with that for now.
Might be too simple.
Budgets tend to be more flexible.
Mm-hmm.
Than our forecasts tend to be more flexible than budgets, because budgets, you put those in, like I said, you put those in stone, and you kind of say, this is how I'm going to measure myself each and every month. A forecast can be a lot more flexible because it can change on, hey, I lost a client today. Well, that changed your forecast. Are you going to change your budget? No. I got 55 new clients. Well, I think we're going to have to change the budget because that's a pretty major change. But if I got one new client, I'm not changing my budget. Does that kind of but it's going to change your forecast.
Excellent. Okay. Question. Why bother? Why bother planning or forecasting? What does it do to grow your business?
Well, the first,
you go ahead, Scott. Yeah.
Well, first and foremost, when you do a budget and you do a forecast, you're being very proactive with your business. Mm-hmm. Say, this is what I plan to do in the future, and I'm going to do everything I can to stick on this budget or this forecast, and I'm going to run my business based off of this. If you don't do that, you're just reacting to things as they happen. And when you're reacting and you don't plan for the future, bad things happen. You just basically, you're in firefighter mode and you constantly are just trying to put fires out. So, sorry, I stepped on you, but that was kind of the
no. We're and it's going to happen because both Scott and I are very passionate about this piece. Is I think the thing is intentionality and proactivity is the reason. I think everything that you do in your business should be done with intentionality. You shouldn't just go into work and work just because. There should be a reason for everything that you do. And so here, with every step that we take along bookkeeping, and my team knows this, there's a reason for what we do. If we don't know the reason, that's where we come together and make certain. There's that that Christmas ham analogy of the little girl who's asking her mom why they cut the ends off the ham, and says, well, I don't know. My mom always did that. So they go ask grandma, and grandma says, well, my mom used to do that too. And well, great grandma's still alive, so they go ask her and says, oh, well, when I was growing up, our pan was too small, so my mom used to cut the ends off the ham. So now you have 5 generations of doing that. But we get in that habit of just doing what we're used to doing, habitually. And so if you have a reason for doing everything, it ends up being a lot, it really is freeing, and it gives clarity. So there's a reason I'm spending X, Y, and Z based on my budget. So the other analogy that I like with that is if you're on a plane and you're flying to Hawaii, those pilots are off target 99% of the time. And they are making small corrections here. And if you don't know how you're doing, first off, they have a plan. They know what they have to do to get there. But now they're looking at this stuff regularly so they can make these small changes, not end up, completely off target. They're not driving for 2 hours and just checking that in. They're making these small changes. So if you don't track this stuff regularly, you're not able to make informed decisions about your business, and you end up doing a lot more running, spending a lot more energy, and are a lot further away from your goals than you would be if you pay attention to them.
Excellent. Do you guys have more? Sorry, Scott, I thought maybe you were going to jump in there.
Yeah, I was going to.
Yeah.
One of the things about, actually, I lost my train of thought. Let's go to the next one, and I'll catch you in a second.
I'm sorry about
I'm
that.
sorry. My phone buzzed,
there.
and I'm turning the volume off so it doesn't do it again, or it doesn't ring, and then I lose my train of thought.
Well,
This is what happens in real world.
I'm going to do the same right now.
I'm going to keep us here for a minute anyway. I wondered, because I know, everybody learns in different ways. And Scott, Eric, I loved your example of the ham bone. So classic. Are you guys able, sorry to pull it off the fly, but can you share at all any real life experiences maybe that you've helped a client with, or maybe a win or a loss that you saw happen because somebody either didn't plan or they did?
Well, I'll start with one that I've had this conversation with a whole bunch of times with business owners as they get to a certain size. And do you want to continue just having a job, or do you want to actually have a business owner, or to be a business owner? Because right now you're being a business owner and an employee, and you're doing neither one of them very well. So how do you get out of that? Well, you have to have a plan. It just isn't going to happen overnight. And do you have all the right people on your team to help you get there? And that's the biggest thing on this is, and if you don't want to be a business owner, if you don't want to plan and forecast and budget all these things, that's fine. But you're just going to be in firefighting mode the rest of the time, and it's not going to be very fun. You're going to have a really 80-hour job basically, and you're not going to be a business owner. Do you want to be a business owner? And the answer, there's no wrong answer. If you don't want to be a business owner, that's fine. This is part of it that comes with it. This is the fun part that I think of being a business owner, because you start taking yourself out of the operations and start running the actual business itself. Are you working in your business, or are you working on your business? And this is the big step of, I need to start working on my business and get out of it. Because if I'm just going to work in my business, go get a job and have somebody else run it. So anyway, so that's the biggest question that I always bring with somebody is like, why are you doing this?
For me, this is difficult. I talk more about it now, but this is an example about me. So in 2000, I started this business, and for the first 5-6 years, I grew this just by running faster on that treadmill, dumping more hard work in, more time, more energy, more money. And we were up to 17 people on our staff in 2006. And that's when we started feeling the bottom fall out with the real estate market. And we were heavily invested in construction and real estate. through that, ended up realizing that I wasn't paying attention to my numbers. And when these things are happening, if you're paying attention to them, you can be nimble, you can make changes. I wasn't doing that. And before I knew it, I ended up having to shrink my company down into at the end of 2007, down to myself and one person. Got rid of all the other things that we were doing and focused on what we did better than anyone else. And I wish I was neutral at that point. I ended up being $300,000 in debt because I wasn't paying attention to my budgets, my forecasting. And I thought at that point that, God, I wish I knew a quarter of what I thought I knew when I started this. But and I thought that just by working harder, that would be enough. And that, and it really broke me. I mean, I was pretty much starting over. Fortunately, didn't lose my house, anything else. Did spend the next 10 years paying off that huge debt. But now it is freeing when I'm able to see where we're at each month and how our work is paying off. And that's what all these metrics do. So there are things that internally here at Drive that me and my team, we look at daily, weekly, monthly, quarterly, and annually, and they're different things. And prior to that, I was driving blindfolded. I just had my foot down, working as hard as I could, and it was exhausting, and I wasn't getting any closer to my goal. So for me, it is it's at the core of who I am and what I do now, because I did it the other way, and I wasted 10 years by by doing that. So anyway, it's it doesn't have to be difficult. You don't have to track everything under the sun, but you need to figure out these few things that you need to track and pay very close attention to them, especially as you develop a team under you, because that's how you tell if your team is on target too, without micromanaging them. So that's for another piece. And
yeah, and to go kind of take off on what Eric was saying, if you're finding yourself having to run faster, you're doing it the wrong way. That's not the goal of the business owner, is to kill yourself. The goal of the business owner is to build something that can either make it a nice lifestyle business where you have time and energy to spend on your business with your family and friends and your hobbies and everything, or is to grow it to something much larger where you're just making sure that it's heading in the right direction. You're the board, you're the CEO or the board chair or whatever, and it's kind of running without you. How do you know you
Right.
built a successful business? You can take off for a month and it'll work just fine. Now, you may not be able to take off for a year because you were that directional leader, but if you can't take a day off, you're doing it wrong. And that's where this planning comes in. This planning, forecasting, budgeting. Who's wearing all the hats in the organization? As a small business, you wear them all. Well, as you grow, you have to start taking these hats off, or you're going to run yourself to death like Eric did. It's not worth it. Go get a job. So, and I know I keep
heard
saying
that regularly from my wife.
Yeah. But that's a common theme. If you don't want to do this planning stuff to get yourself out of the rat race, you're going to end up right where where you've been the whole time, and it's going to get worse. I had a client, a technology company, and we went in and it's like, okay, you're growing to a $30 million company. You're going to be taking that next step to $50, $100 million pretty soon if you do these things. Well, they're shrinking now. Why? Because the owner was like, I don't want to give up control. I'm going to do more. Well, they were on trajectory to hit 30 million. I think this year they're going to hit 18. Why? Because the owner took more control instead of giving up control. She didn't want to do any of the things to help her business grow. She is strangling it. Well, if you don't, this is part of the planning process. You have to be willing as a business owner to start giving up control to grow it. And if you want to have a $15 million revenue company, more power to you. Do it, but just make a conscious decision. I'm going to have a lifestyle business. I'm not going to want to grow this thing. That's not a wrong answer, but you have to plan for that. You have to say, this is what I want my end goal to be. Don't keep telling people that you want to be $100 million and then strangling it down to $15 million. It doesn't work that way. And then your best people are going to leave, which actually is happening.
Yeah. It brings us kind of right into, we've got a question in the chat box and in our third sort of topic point, which is, what are the first steps a business should take? Either you can start with budgeting or forecasting. Which comes first? I think we kind of touched on that a little bit, but yeah, how do they jump in?
I would say that you have to figure out what's important to you first, what your goals are. So forecasting for me comes first. This comes down to a business plan. I do want to piggyback one thing on what Scott was saying there. He's talking about the difference between really self-employed and business owner, pulling yourself out of those roles. And there are a different set of responsibilities and tasks that you have to do as a business owner. And it takes a different skill set than doing whatever it is that you do in your business. And like Scott said, there's no wrong answer, but that was a difficult one for me. Hey, I'm a great accountant. I've used QuickBooks since '92 when it was introduced. I know this inside and out. I'm really good at process. That doesn't help my business. That helps me tactically when I'm working with clients, but it doesn't help my business grow. So being able to plan and figure out how to, where do I bring the highest and best use to my company? If it's in that role, great, then focus on doing that. For me, it's actually building relationships, creating the direction of the company, and helping us grow. And because I can find people to do these other things. So like Scott said, there's no wrong answer, but you do have to figure that out. With that, coming back to first steps to take, again, for me, it's forecasting because I'm doing the planning. And at the beginning, you're wearing all the hats. So this is where you have to figure out, hey, what can I get off my plate, especially if I plan on growing. And all of these other decisions are based upon your destination and then the steps you need to take to get there. Once you have that, then you can start building the short-term budget. And like Scott said, it can be quarterly or annually, and they can be short-term because especially as things are growing. But you got to figure out where you're going first, and then start developing that roadmap of how to get there.
Kind of take off on one thing that Eric said, and actually when Catherine first asked me to do a couple of these, and she's like, what's the first thing that you would tell somebody? And I was like, what's your 10-year plan? And then she's like, well, I have this other one, Cash is King. And she's like, what was the first thing I say? What's your 10-year plan? I was like, it's the same question. And that's that business plan. And it doesn't have to be a 30-page business plan. It can be one page. Just what are your goals? Who's on your team? And what resources do you need to execute your plan? That's it. I mean, that could be one page. If Jessica wanted to grow her practice into more than just herself and have several locations, what does that look like? How many locations? Do you want to keep practicing? Do you not want to keep practicing? What is that plan moving forward? And if you want to keep being in practice, that's great. I'm going to be talking to a dentist that they have 3 locations, and the main business owner still practices in one of those locations. Her husband is the business manager. Well, that's great. I think they're trying to open a new practice too. So that's fantastic. They had a plan and a vision to execute it. I have another friend, actually, oddly enough, also a dentist. She has no plans on growing her practice beyond herself. She just wants to keep being a great dentist. Both of them are great, but they have a plan in place, and it's a written plan. It's pretty amazing how well you hold yourself accountable when you write it down. There's a famous, Bill Gates had his plan on what he wanted to do with Microsoft, and he wrote it down and he put it on a little notepad and he carried it around with him everywhere he went throughout the entire 70s. Everywhere he went, he had that thing, and he'd wake up in the morning, he'd look at it. What And what did he do? He grew Microsoft. Why? Because he had a plan, and he just he reminded himself of his plan all the time. And that's your business plan. A business plan you're going to use a lot of forecasting in, because you're just spitballing. When you start getting a lot more detail inside of it, that's your budget. And that's when you start measuring yourself against that budget. And then when your big things change, well, change your budget then based off of big things, not little things, big things. And that your forecast is not going to be constantly changing. So yeah, the first thing to do is, where are you going? And that's going to be your forecast.
So we know the first thing to do, and I would take a guess that in the stages of business planning, there's some budgeting and forecasting happening. So aside from that, how often, how frequently, is there a certain time of year that it makes sense for you? I know you've said it's ongoing, and you kind of have to do these different pieces. Is there sort of a hard and fast, bare minimum versus your best practice of how you do these two things together?
I do budgeting annually, and we review it quarterly. If we've had, well, we review it monthly, but we assess it. And normally you don't tweak your budgets. We do with intentionality, because we've been growing quicker than what our plans were, so we needed to. Our overhead stays about the same, but we ended up having to put, anyway. So if you have big events that can change things, then that's when we'll go back to budget. And usually we don't look at that or reassess that any more than quarterly, and we try to make them small changes. We only change that if something big happens. I want to know if I planned to spend X on, on my server costs, but it ended up actually being, twice that, or whatever the case may be. I want to know where my money's going compared to my plan, because that lets me know, hey, how's my thinking? Am I on check, or am I on track with that? I do a lot of that with project costing for contractors. And this is, so a good example is someone, for your WIP list, your 80 to 100 items for building a home, framing, plumbing, cleanup, all of these things. Someone will code something because they had money left over in framing, but they ran over in this area. I'm like, no, code it to whatever it was. I want to see that you were under here and that you were over here, so that you can bid your next job better. And that's really what these budgets do additionally, is they let you know, hey, this is what I thought it'd be. And wow, I was off. I need to do better. You're calibrating that your sense of your numbers regularly. For forecasting, we really are looking at that each week, because we're tracking our sales pipelines. We know the deals that we have out there. We know when we think they're going to come in. We know an approximate dollar amount that they should be, and then we have a confidence level on, hey, we're 70% certain that we're going to get this. So when you look at the law of large numbers, all of these feed in and say, okay, this one's going to be $2,000, and we're 70% sure we're going to get it. 1,400 of that goes into that bucket during that time. And so we're looking at that stuff weekly, with how we're doing of actual versus versus our forecast, and we're looking at saying, okay, over the next quarter, this is where we're going to be.
Okay. Oh, go ahead.
Oh, yeah. No, I was going to say how often you want to revisit this. And on the budget, you should be looking, your budget is your gauge on what's happening moving forward. And then I always like to do the budgets to start your new year off, and then revisit them throughout the year. Each month you should be doing budget to actual comparison. And if you've done your budgeting correct, which means you've also done your forecasting correct, everything, your actual numbers should just be validating your budget. The further off you are to budget to actual, the less you know about your business. So the closer you are to your budget and your forecast, the more you know about your business. And a great example that Eric just said is how you're bidding. If you're way off on your budget actuals on your construction costs, you don't know your construction very well. So you need to go back into the drawing board and figure out on your whoever's doing your bidding to go back and say, hey, we were way off on framing here. We lost money on this job because we didn't know how to budget it correctly. We have to do this better. Well, the same is on the rest of the business. If you're way off on your budget to actual, you don't know your business very well, and you need to go back and get inside of your business and figure it out. And that doesn't mean I need to work harder, or I need to see more clients, or I need to get more construction jobs. No, you need to figure out what your budget is so you're billing things correctly so you can have a successful business. And this is the part of working on your business versus in your business. And if your budget to actual, if you're way off on things, that's the first year, that's fine. You're figuring it out. Year 3, 4, and 5, if you're way off on your budget to actual, you're doing something wrong. And you need to figure that out, and you need to budget better because you have to figure things out better so you can grow. And when you're doing this on a $1 million business, a 10% variance is, it's $100,000. It's a $100 million business. That's $10 million. You figure it out when it's small before things get big. And that's how you really understand your business, and going through and planning and budgeting and forecasting. That's all those reasons how to make sure you understand your business so you can grow it correctly.
So we've got some great questions. And one of the first one is, and I'm looking also at the group that we have here. I was originally going to ask you to look at, give us some ideas for big businesses and smaller businesses. I think we can probably focus on smaller businesses for the group we have today. But tools, what are your favorites to use that you might recommend to people to start this process? And I just want to see tools or programs would be another way to look at that. And I want to make sure I got everybody's in there. The other one is, if your business starts looking for a bookkeeper, what things should a business owner look for, and what would be potential red flags?
I was writing that back right now to Stephen. It's hard to answer it without sounding like a commercial for our company. So I'll be generalistic on this because that's not my intent here. But 9 out of 10 bookkeepers that I run into cannot read a financial statement. They are just doing data entry, and these are professional bookkeepers that are out there hanging their own flag. So expertise is one pillar that you want to make certain that they have. It's really hard to gauge because you're the business owner and that's not your area of expertise. So you're assuming that the bookkeeper knows what they're doing. But they are, again, if they're just doing data entry, they don't understand what's happening behind the scenes in QuickBooks. You might see behind me, I have a journal entry up there where I was working through a vehicle purchase with my team, training them on something. We understand what goes on behind the scenes. You're not going to be able to really assess that. So talking with, getting CPA references from them, talking with other clients of theirs, maybe asking for a client that it didn't work out with, because there's always those stories as well. Making certain that you're not just getting the, hey, I can find 10 people that are going to say things great about me, but I'll often send someone over that I no longer work with as well, so they can see how that went as well. So really, it's references, it's talking with other people. That's one piece. The next one is proactivity and the ability to do the work. Unfortunately, most bookkeepers are one-man or woman shows, and especially right now when it's time for Johnny to do homeschooling, guess what? Your stuff is going to wait. And this was bad before COVID. I think it's going to get worse now. A lot of solo practitioners are getting stuff to their clients at 11, 12 o'clock at night, catching up. They're constantly behind. And that ends up being a problem because now you don't have timely data. So accuracy and timeliness are the two things that you're looking for in financials. So you want to make certain that there's a support system there If it's just doing a piece of your accounting, then a standalone bookkeeper, could do okay. Personally, that's why we created a firm, is so this way, if something happens to one person, we cross-train in here, someone else is able to come in. So, those are the two big ones for us. There's a few others that set us apart, but again, I don't want this to turn into a commercial.
On the bookkeeper side, on Stephen's question is, what is the best use of your time as a business owner? Is it entering AP? Is it paying bills? Is it recording revenue or figuring out your journal transactions that you have no idea what you're doing? Is that the best use of your time? Yeah, I could probably replace my toilet at my house, but I'm going to hire a plumber because I want it done right. Because if I do it wrong, there are major ramifications from me doing it wrong. Could I probably do it? Maybe. But this is why we hire professionals. As far as hiring a bookkeeper, Eric is correct. You have the people that they know QuickBooks and they can get information into QuickBooks. But in what form is it in QuickBooks? Is it close to even accurate? As an accountant, if the balance sheet is correct, your income statement, at least the bottom of your income statement, is correct. But most of the time when they say, hey, I've reconciled the accounts, they mean I've reconciled cash. Well, there's a lot of assets and liabilities accounts that need to be reconciled. So just understand.
Scott, did we talk about this together? Because I use almost the same words. This is creepy.
No. So
okay.
Just going through and just understanding what it means to be a good bookkeeper. So going back to when Stephen's question, when you're just starting your business, you have to just get the information in. It's more of a compliance thing. I have to get the information into, whether it's QuickBooks or Indeniro or Xero or whatever. It doesn't really matter what it is, your GL system. Get a GL system and get the information in there. And you got to do that so you can file your taxes at the end of the year, and you have to do that so if the bank asks, you at least have something. Is it accurate? Can you make business decisions off of it? Probably not, but it's accurate enough to file your taxes. So, but as you grow, that information has to be more and more accurate so you can make business decisions. So when you go to the bank and the bank asks you a question, you actually have a good answer for them so they can give you a loan so you can have more resources to grow your business. When that CPA asks, hey, I'm not sure if I can deduct this or not. Well, do you even know what this is? You don't even know what the entry is that they're asking about. Well, the lowest level bookkeeper, the one that Eric talked about 9 out of 10 times you'll get, they're just going to put information in, and they'll have there'll be a QuickBooks Pro advisor, or there'll be something. They'll know QuickBooks inside and out. They don't have a clue about accounting. So they can get.
They might know QuickBooks inside and out.
Yeah, but they don't know about why they're doing it. And a good difference between most bookkeepers and an accountant is the accountant knows why, not just why, but they know that the numbers need to tell a story, the story of your business, where it's going, where it's been. The base numbers of accounting is you account for what happened. So are you accounting correctly? And if you are, then you can report correctly. If you're not accounting correctly, you cannot report correctly, and therefore you have no idea what your business just did. So
there's also levels of detail that you're going to look for in your accounting. When you're starting out, as Scott was saying, to get the compliance issue of getting your taxes done, that could be as simple as doing a cash-based accounting, meaning that I code my deposits that came into income, and I code my expenses to the few expenses, to the different expense accounts, office supply, rent, etc. When you get a little more sophisticated, that's where you start putting other layers on there. Saying, hey, maybe I'm going to start doing invoices through there and breaking things out by items so that I can still see. Well, for our business, we'll have an account, which is accounting, accounting revenue or accounting services. But we have multiple things. We have our bookkeeping, we have our controller functions, we have our cleanups versus maintenance. We have all of these different items that point to that. So now that's another level of detail that I can do. And now I can start tracking things on there to say, hey, where that new business came from. So I can see, okay, this is the number of clients that we've gotten because of our involvement in the Tigard Chamber. And these are the people that they came from within that. So I know who I should be spending my time with. So there's all these different layers that you could do, and you can make these, you don't want to make it more complicated than you need to, because I can set up this great system that's going to track everything under the sun for you, but if it's too complex, it doesn't get used, and you're spending a lot more time tracking things that aren't providing value. So I really subscribe to the KISS principle to keep it super simple. There's a not as nice way of saying it, but there we go. But so you keep it as simple as possible, but you can always add more on there. As you do that, that's where you start having this information. And so I do have to, contest. It'd be great if bookkeepers knew QuickBooks inside and out. What ends up happening is they've done private accounting for one or two companies, and they know the modules that they used in there really, really well. But then there's all the other things that may not be particular, that are particular for your business that aren't in the ones that they worked on before that they may not know. So that's where having a team and working with a bunch of different types of clients helps us out in that role. But because we do run into bookkeepers all the time that just know the basics, and they know the basics really well, but they're not looking at those other asset accounts or other liability accounts like Scott mentioned on the balance sheet to know, hey, is inventory right? Have you done any depreciation or amortization? Have you brought up to date your, even your auto loans? A lot of people do those at the end of the year. And because of that, your profit and loss is not correct if you don't do those. So anyway, multiple layers and other accounts and whatnot to pay attention to. It's, you don't have to do all of them, but you do have to figure out what you do and stay consistent.
Okay. John, thank you so much for joining us. I have a question here about how does cash flow analysis fit in with forecast and budgeting? Talks also same as timeframes for updates or more frequent, same timeframes for updates or more frequent. They're in retail business, so things can be a little more seasonal.
Well, it's funny because I was just thinking about cash flow when Eric was talking, so it's funny that that was the question that came up. And my first thing is your income statement is not your cash flow statement. So let me repeat that. Your income statement is not your cash flow statement. There are a lot of variables that happen. Your AR goes up, your AR goes down. Your inventory goes up, your inventory goes down. Your payables go up, your payables go down. You make debt payments. All these things happen that aren't reflected on the income statement. So your cash flow statement is a combination of both your balance sheet and your income statement, your profit and loss. That's the combination of the two. And that is key. And I don't know how, I had a business owner that I worked for 7.5 years. I never got through to him that there was a difference between the income statement and the cash flow statement. And really at the end of the day, that was a failure on my part. But he said he bound in a term and he understood it every month. And every month he would come back with the same questions. But as business owners, if you're not willing to learn and you just understand that those are different things, then it's going to be hard in the long term. Brilliant in other areas, just not there. And also the biggest thing about bookkeepers that don't know what they're doing is they don't understand that concept either. And so they can't help you. And that's why when Eric's talking about is your inventory, your AR, or your AP correct? Well, that affects your cash flow. And if you don't have those correctly, entered correctly, it's really hard to forecast your cash flow moving forward without that information. I don't remember what the rest of the question was, but that was.
Well, just because I want to make sure if and John, if you want to unmute and chime in, I think we can actually probably switch to that. I'll pose one more question, and then if anybody wants to unmute and share any thoughts or takeaways from today, I would ask from Eric and Scott, any pitfalls that you're like, just don't do this one thing, or I know sometimes you hear things like don't go into business with your friends, or just to be thoughtful about that. You guys have shown a ton of insight today. I think there's a lot of little nuggets in there, but if there's anything that we haven't asked or you are just want to make sure that we hear about.
Yeah, I have one for starting new businesses. I get this one a lot. These are businesses that are just starting. Please don't commingle your money. Set up a business account. Put all of your expenses through there. If you need money personally or you need money business, transfer the money and spend it out of the right account. Because this way, even let's say you haven't done any accounting, that cuts our time down drastically, not having to go, because otherwise we have to go through both your personal and your business account to identify, or you do, to identify all of the expenses. You're more likely to miss things. I'll tell you what, as a result, if I spend cash for my business, I'm married, so I don't often carry cash. But if I do, I don't plan on writing it off, because I know that I'm not going to get back to my, to turn a receipt in or anything else. So anything for our business happens through our business credit card or our business account, and it makes it so much easier to track. If you do things through a personal, fill out an expense report and pay yourself back. But keeping those separate and not commingling them is for a brand new business. Well, really for all businesses, but especially brand new. That cuts the accounting way down when you're not having to hunt these things.
Yeah, and I pulled up John's question here so I can get back to and answer that completely about cash flow analysis fit into your forecasting and budgeting. Part of all of budgeting should take into account your cash flow and the times of year. So you're looking at, hey, when do I have to make my annual insurance payment? Or, hey, if I'm in the retail business and I know it's very seasonal, I have inventory buys at certain times of the year, you have to factor that into your forecast model to say, do I have enough cash flow in November or in November for my spring buy? Do I have enough or can I get terms on that? Mm-hmm. What are my resources? What are my options? If I have to pay cash, do I have it? If I can take it on terms, have I set that up? And you have to start thinking way ahead of time so you can get all of these things planned for. Can I get it through? Can I get 90-day terms? If not, am I talking to my bank? How am I going to get these resources to make those inventory buys? And then as the money comes in, make sure you're paying that stuff off first, making your debt off first, because the next year is going to roll around and you don't want to have maxed out all your resources. But yes, cash flow analysis is key to making sure that in your budgeting process, specifically in your budgeting process. And that goes back to, are the numbers entered correctly? Because if you're not accounting for all your liabilities and all your receivables in your inventory, then that's going to throw everything off. So your numbers have to be accurate for you to do an accurate forecast. It doesn't mean you can't do one if your numbers aren't accurate. It just makes it very difficult.
Mm-hmm.
All right. Well, I think that's it for today. We're right on time, which is fantastic. I just want to thank everyone for attending today, and also, of course, to Scott and Eric.
Do we have a little bit more time?
Because if you have more to say. Do I keep cutting you off? Is this a thing I do, Scott?
Well, she threatened to TP our houses if we didn't talk, so I'm glad I showed up.
Well, cash is king. Isn't that the name of the webinar? Well, it's interesting when you go through in your personal life, hey, I want to make sure that I can save for a vacation, or I need to lose weight. What's the number one thing that you need to write down? Everything you've eaten, or what of all of your expenses, so you can rely on that monthly or daily your calorie intake or your expenses that you're paying, because your income's, if you have a W-2 job, it's fairly flat. If you have a business, it may or may not be flat, but at least you have a general idea of what it's going to be. And so you can really control your expenses. Well, we're in an interesting time right now in COVID. So you have a lot of business owners that are out there that either A, have a very distressed business, or B, the realities of COVID are going to change how their business is going to function moving forward. Well, there are a lot of business owners that either, if they're distressed, they have to figure out how to get out of their business. Or if they are, let's say they're a baby boomer and they're like, going, I don't want to live in this new COVID environment. I just want to sell and get out. Well, if you have cash and you've planned correctly, you can take advantage of this. There's going to be a lot of businesses that are on sale at a discount. Well, if you want to grow your practice, you can do it two ways. One, through acquisition, or B, organically, just growing organically. Well, if my competition's across the street and that's on sale, well, I might just go buy that business, and then it's a lot easier to grow my practice that way. But if you don't have cash in the bank, or if you don't have a well-executed plan, it's going to be hard to get the resources to go take advantage of those opportunities. And guess what? Your competition is going to take advantage of those opportunities.
Amen.
So put yourself in that best position to take advantage of the opportunities that will be coming. There are more millionaires made during down times than there are in good times. Why? Because of this fact right here. During the down times, everything's on sale.
But they prep for it during the good times.
Yep.
And so that's one of the things. So those are excellent points, Scott. So through this, you're able to also, in your budgets, create buckets for cash. So often what we'll do with a lot of our clients is either they'll have separate savings accounts, or they'll have one that we break into buckets and say, hey, this is money that we're setting aside for your emergency fund. This is money that we're setting aside for taxes. This is what we're setting aside for profit sharing, and this is what we're setting aside for owner's draws. And this way, you're not just always pulling this money out, you're planning for this. And that way, when you need it, it's there. I'm working with a client I was on the line with yesterday, a set of realtors, and they run a brokerage. They had about $90,000 in tax between the two of them that they had to pay. Great problem to have. But sitting down with their financial advisor and their CPA, because we try to do these things as a group so everybody's on the same page, we've got it now so they can put, they have to put about 180 grand away between the two owners, but they're going to have zero tax liability this year. The only reason that they're able to do that is because we've created those buckets and they put that money away ahead of time, so that now they have this opportunity. They're putting 180 into their retirement that they can pull back out later or borrow from, or whatever the case, but they're not paying it to the government right now. And now that full 180 is going to be working for them. Again, they can only do that because they planned and budgeted for that up front. So don't just budget for expenses, budget for future equipment, budget for acquisitions, budget for draws, taxes, profit sharing, and emergency fund. Things that may not be leaving your account right now.
Yeah, and Eric touched on something really important. And as good as tax CPAs are in doing your taxes, they're very poor business planners. So they come at it with one mindset and one mindset only. And this is not all of them, so I don't want to throw all of the CPAs under the bus. I mean, I am a CPA, so I know most of them. But their goal is to get your taxes as low as possible, to get you to pay as little in taxes as possible. Well, there's a problem with that, and this is for growing businesses. Banks like to see profitable businesses when they're going to give you a loan. So if you need to get a loan for your business, or if you need to bring on investors for your business, they like to show profitable businesses. If you're constantly getting your expenses as high as you can so you show as little profit as possible, that's going to limit your ability to get a loan or your investments in there. So you can time it correctly. The old adage is, what's 2 + 2? Well, accountant will ask, what do you want it to be? Because there's timing involved. Well, it's going to be 4 in the end, but for the first 6 months, it's going to be 3, and then we'll add another one on later on. So it all boils down to timing. Well, CPAs are like, I'm going to get your taxes as low as possible. Well, now I can't get that business loan and I can't buy that business across the street. Thank you, CPA.
Does that fit in with your overarching goals and your planning that you figured out through your forecasting?
Yeah, and if you don't have that written down, and if you don't set that expectation up front, if you tell the CPA, hey, I need to show a big profit this year and I'm willing to pay a little more in taxes because I'm going to buy that business across the street because it's 50% off, they'll do that. But if not, they're going to go to that default button of, hey, I'm going to get your taxes as low as possible. Well, yeah, that might screw your ability to buy that business across the street.
And that's why it's so important to collaborate with your professionals. You know, talk with your CFO, talk with your CPA, talk with your financial advisor and your attorney, and make certain that everybody, and yes, it does cost a little bit more money when you're taking everybody's time. But I'll tell you what, you're able to do so much more. You have so much more opportunity and so much less wasted effort and time by not doing it. Time's the only thing we really can't get back. That's where, when I look that I wasted 10 years, it kills me. I make better decisions now because of it, because I'm not willing to spin my wheels like that again. And so trust your professionals. You got to find the right ones that understand you, understand your business, and that are willing to work with other people. Because without that, none of us as business owners need to be on our own. And that's a big core core piece. For me, I was on my own before, and it was really tough. I now have surrounded myself with other people that do what I do. As far as entrepreneurial business owners, driven, trying to grow, and we talk regularly because of that. So it's not, so we're helping each other. So anyway, surround yourself with your professionals. Find a community with that, and if you have questions, I'm always happy to be a sounding board with this stuff, and I know Scott is as well.
And the last thing I want to leave everybody with is why. Why are you doing this? What is the point of this? I had a great mentor at the CPA firm, first mentor that I really had that was non-family member. And she mentions, like, why are we doing this audit? Why are we doing this tax return? Why are we doing this business plan? If we can't answer that question, we're not adding value. So as business owners, everything you do, whether it's a tax return, or if you have to do an audit, or if you're doing a business plan, or if you're doing a budget, or whatever, why am I doing this? What is the end goal of this exercise that I'm going through? Because each of these pieces, whether it's a tax return, or whether it's your budget, or whether it's your business plan, that is a tool that you're going to use to help you in your business. If it's not going to be helpful for you, don't do it. So always think, why am I doing this? And if it's a checkbox item and you're only doing it to check a box and it's not going to help you move forward, stop doing it. So always ask that question, why are we doing this? And it'll be amazing from yourself to say, oh, wow, I really don't need to cut off the ends of the ham because I don't have that pan anymore. So
it goes back to that intentionality and doing everything. So Scott, I appreciate the heck out of that.
Yeah. All right. This time it's for real. We're out of time. But again, thank you guys so much. I always appreciate hearing from both of you. And thank you to everybody who attended today. Please stay tuned. So we are holding another webinar next month. So we'll hold webinars 2 to 3 every quarter here for the Tigard Chamber. I do love the end of our conversation where you guys talked about having the right people on your team and around you. And I'm just going to put a plug in for chambers because that's what we do. We build business together. We get to know each other. There were questions about, what about red flags and how do you pick the right person? Sometimes it's about getting to know people. It's a like, know, trust factor, right? Who works best for you? Who works best on your team? Who integrates well? I love what you talked about, Scott, with integrating your CPA into this other work that you're doing and having that open communication so that you really reach your goals. So with that, please check back in October. We're going to talk about strategic planning, another really fun topic. But again, very, very needed in your business and goes right along with everything here.